Hi, my name is John Sablehouse, and I am a non-resident senior fellow at the Brookings Institution in Washington, D.C. I'm going to answer a few questions about the paper I wrote for the Aspen Economic Strategy Group called Will Population Aging Push Us Over a Fiscal Cliff?, which will be released December 12th in the policy volume, Economic Policy in a More Uncertain World. First, let's start with a few summary facts. In the year 2000, 12% of the US population was over age 65. By 2050, that share will be 22%. As of 2022, we're already at 17%, so about halfway between the two. Population aging is applying upward pressure on government deficit as a result of increased public spending on programs such as Social Security and Medicare, which are designed to support older Americans. In my analysis, I separate out the aging related components of the federal budget, such as Social Security, Medicare, and other health related expenditures from the rest of federal spending. What we see is that the spending that is directly related to the retirement of the baby boom generation is expected to start leveling off after about 2030, when the last of the baby boomers cross the retirement age threshold. However, the federal debt continues to accelerate through 2052, which is as far out as the current CBO forecast takes us. So this surge in spending beyond the retirement of the baby boomers is mainly driven by net interest payments on previous government debt, which are expected to exceed 8% of GDP by 2050. And also what's known as excess health cost growth, which is the fact that spending on healthcare is exceeding GDP growth and what we would expect from aging alone. So the question is, the US has been running a structural deficit for some time, which means that tax receipts are not covering the basic cost of government spending, even in non-crisis times. So the upshot is that population aging doesn't explain the exponential growth in spending. Deficit spending, the surge in COVID-19 related outlays, and ballooning interest payments contribute to spending, while changes to the income tax code have actually slowed the growth of revenues at the same time. So when we think about Social Security and Medicare, we have to think about why they exist in the first place. They exist to improve economic welfare, which means their overall net benefits exceed the cost. And I think that's very much true, which is why there's such strong support from the voters. But even when that balance is correctly struck, social insurance can lead to redistribution, both across generations and within generations. So what do we mean by that? Within generations, Social Security redistributes from high lifetime earners to low lifetime earners within a generation. So both Social Security and Medicare generate redistribution across generations as well, because the timing of when you receive benefits and when you pay taxes is different. And for example, the current generation of retirees may be paying more or receiving more in benefits than they paid in taxes while they were working. That redistribution then is in fact paid for by current and future workers. So the extent of this redistribution is really based on policy decisions and by factors such as the pace of health cost growth. So to make this a little more concrete, the Social Security Trust Fund is on track to be depleted by about the year 2035. And what that means is that the baseline for Social Security in CBO parlance is that there will be a reduction in benefits if nothing else changes, and the Social Security Trust Fund can only pay about 75% of promised benefits. There will be an immediate and permanent decrease in Social Security benefits at that time. So how Congress decides to resolve the trust fund's depletion will result in some form of redistribution or a change in the amount of redistribution. If benefits are reduced when the trust fund exhausts, then the generation who is receiving benefits at that point in time will bear the burden. If instead taxes are raised to cover the shortfall, then again the burden will shift to future workers who will pay the higher taxes. So in addition, there's also the possibility that the resolution will involve an intra-generational component. We could choose to cut benefits or raise taxes for either low or high lifetime earners when we get it to that point. Medicare has the exact same issues, and with the additional factor that the rate at which health spending is growing is exceeding what we would expect from population growth and GDP growth alone. Healthcare is becoming a bigger part of the economy, so there's even more pressure on future funding for Medicare. So, although it's appropriate to focus on the distributional aspects of these age-related programs, I would also argue that unfunded spending in other non-aging parts of the budget also portend substantial intergenerational redistribution as well. If we're buying things now, we're receiving goods and services now and pushing those costs down the road, then eventually they will have to be paid by future workers. So, in a typical public finance framework, the question we ask about new public spending is whether or not the program improves welfare by either correcting a market failure, such as providing insurance value in the case of Social Security or health programs, or does that program have a very high return on investment, such as in technology or infrastructure? And if the social benefits exceed the cost, well, then we should proceed with the program. We should find a way to finance that program to make it happen. But I think that the important follow-up question, one of the messages of this piece, is to ask whether the costs and the benefits are being matched across within generations. So a couple examples of that. So first, how should we deal with the fact that health spending is rising faster than what we would expect from aging alone and growth of GDP? And it's much of this is due to the fact that our consumption bundle is shifting from housing and food and other types of services towards healthcare. We want more healthcare. Healthcare is a larger share of our consumption bundle. And that's not a bad thing. Healthcare is a good thing, but we should figure out how to pay for it in a way that matches the benefits and the costs more fairly, rather than just say, let's increase health spending dramatically now and push all of those costs down the road. We should think about paying for those health costs now with some possibly another form of taxation, such as a consumption tax. Another good example that motivated me to write about this is the recently passed infrastructure and CHIPS bills. So both of these were the examples of government programs that have high rates of return. We expect them to have very high rates of return. But those rates of return benefit both business owners and workers, right? Everyone benefits from having more efficient infrastructure. However, in the US, taxes on business and other financial incomes have been eroded over the past 25 years through a number of changes in tax law. And it can be argued that wealthy families are not paying their fair share for those new public goods. And so we should think hard about who's getting the benefits, who's paying for these new public investments. And I guess at the end of the day, failure to match the costs and benefits really threatens the political support for desirable government interventions. People are leery of paying for programs for which they expect little or no value, and voters would become increasingly unlikely to support those programs, even though, again, going back to the beginning, these are programs which are efficient, which do resolve some sort of market failures.